What's going on, Hot Take Nation? DRW here. Before we start this week's episode, I wanted to let you know it's being brought to you by a friend of the show, the Kuiper Law Firm, which is, not my word, but true, a multi-jurisdictional, full-service oil and gas law firm with offices in Houston, Denver, Dallas, Midland, Oklahoma City, and Lafayette. The firm is licensed to practice across most producing states, retains significant experience in every producing basin, and provides skillful representation across a wide variety of matters, including title examination, regulatory representation, acquisitions and divestitures, contract review, midstream dedication, and many other aspects of onshore natural gas and oil development. The Kuiper Law Firm strives to create an effective, efficient, personable representation by attorneys that understand and know the oil and gas industry. And every once in a while, they may take a LinkedIn banning case. Not always, but if they're a friend of the show, they'll definitely do it. Not only does their firm have extensive experience representing the industry operators and participants, but most of Kuiper's attorneys began their careers employed by operators. This hands-on experience allows the delivery of legal services that are truly effective and efficient for their oil and gas clients. Though the difficult market presented in the past few years has been tough, the Kuiper Law Firm remains committed to serving oil and gas clients. Alex Kuiper founded the Kuiper Law Firm with a vision of accessible expertise, efficient and quick service, and a client base revered as friends. I can attest to this. Recognizing the many hardships on industry professionals today, the firm actively participates in free educational events available to all, welcomes questions from industry's professionals that they address in their blog, and is available to all clients and non for guidance in these challenging times. So, thanks to the Kuiper Law Firm for sponsoring this week's episode, and on with the show. What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. I hope that everyone had a wonderful Thanksgiving, whether you chose to socially distance or not. It is totally up to you, in my opinion, just like it is up to you to wear whatever earrings that you want. And Casey Merriman is joining me. And first, I have to say, those are the greatest earrings that I have seen in 2020.
Thank you.
Walk me through the lemons. Is there a significance to them? Does it inspire you to want margaritas post-Thanksgiving? What is happening?
Well, so actually, funnily enough, most of it has to do with covering the oil and gas industry and going to conferences and everyone usually wearing black suits and being kind of boring. So, I'll rock the appropriate attire, but I usually go for flare earrings just to offer something of interest. So I actually usually have lots of feathers, but today I got my lemons.
I am a huge fan of them. And I think that it actually tees up a great conversation, which is when you have lemons, make lemonade. And when it comes to the oil and gas industry, really going back to 2014 to 2020, where we've kind of been in a bear market with maybe a couple positive moments in there. But the last 3 weeks, or maybe month really, since the election and the vaccine news, has been like the second coming of E&P euphoria. Walk me through your opinion on what we've seen, what's changed, how the market hadn't factored in a vaccine when the president had actually literally said a vaccine was coming, and where we sit vis-a-vis commodity price today. And then I want to dive into one of the pieces that I saw that you wrote a couple weeks ago and then followed up on this week with the write-offs on Exxon. But let's start macro, oil, gas, election. What in the world has been going on in November?
Yeah, well, I mean, on a fundamental level, actually not a whole lot has changed, right? I mean, that we're still the world is swimming in oil and it has massive inventories. There's a reason why OPEC plus is sitting over struggling on what to do, right? Because the macro outlook going into next year is still severely challenged. Even if a vaccine or 3 or 4 can be implemented, and hopefully that's the case, and we can get back out there and back to work, it's just going to take a time to work off a massive amount of supply. It seems like so much of what we've seen, yes, there is a bit of hope, looking forward to what may come, but also just we've fallen so far, so hard, so fast, matter of whether it's shorts getting squeezed or just trying to buy and maybe not miss the bottom. Why not grab onto something while it's here? But, on a fundamental level, though, there's still a lot of work to be done, and there's still, with the election, it offers some potential certainty. Okay, we kind of know a bit what we're going to get, but there is some challenges that the industry may face there. Given how kind of the landscape worked out, I don't think it's kind of the worst case scenario that the industry may fear in terms of what may actually be done around restrictions and it actually severely impacting how the industry works here in this country. But, there could be some headwinds ahead, and certainly the industry's had quite a number of them in this past decade.
So today is December the 2nd. And the reason I put that out there for listeners, because this episode will come out on the 6th. And it's important for people to take that into consideration because OPEC was supposed to have a Sunday. It might have even been it was a Saturday, and they were going to have a pre-meeting to get agreement for the meeting, to have the meeting to do. It sounds actually like a big corporate bureaucracy around how they do their meetings. It's like, I'm sure at Exxon you have 19 meetings to have the decision be made. That was the one that everyone recommended. But so we're going to get it Saturday. Then they didn't get agreement and it went to Sunday. And then it was Monday, and then it was Tuesday, and then they pushed it to Thursday. If you were to speculate, what are they talking about? And what do you think that the outcome of this meeting is going to be?
Mm-hmm. Yeah, I mean, because basically there's a couple parts of it, right? There's OPEC itself that meets first, and then there's this wider OPEC plus group that was established a few years ago to bring in Russia and others to try to, maximize the number of producers that are willing to voluntarily curtail production. And so you kind of have to go through this. I mean, the biggest kind of sticking point that's happening is that while everyone benefits from oil prices not being negative 37 anymore, voluntarily pulling back so much production is inevitably cutting desperately needed government revenues, right? And so it just becomes really, really difficult to sustain these, in some cases, for those that really do have spare capacity to continue, month after month after month, hold back, is a challenge. And, they're trying as hard as possible to get everyone to comply 100%, share the burden. Free riding has been a longstanding problem in OPEC, but not all the countries kind of feel like the stick is brought with the same force across the group, right? And so it's just, they're really having to kind of come to a place where they're willing to take it a little bit longer. What they are really discussing now is an extension, right? So OPEC plus, unless everything blows up, which is not expected, is going to continue cuts into next year. It's whether to continue the current higher level than they had agreed at back in April to continue. So I do think that they will sort it out. There will be lots of grumbling in the meantime, but I do think, though, that the oil market should not underestimate the stress that is happening within OPEC plus. I mean, this is really something that the market needs to watch and be considerate of going into next year, because, from our standpoint, in terms of our own numbers and stuff like that, OPEC Plus really needs to stay on course throughout next year to get that balancing in effect, even if demand starts to come back. So it's maybe kind of an underappreciated risk going into next year.
So it's interesting to me because March is very vivid on my mind. And certainly, commodities are different than equities where, countries, companies, like you can move markets by making choices when you control paper or have physical. And, I'm not trying to tinfoil hat this, although all through 2020, I seem like I'm just throwing the tinfoil hat on and going like, what's going on? But, Russia sort of messaged through February, some could say, that they were going to break apart OPEC. But also, interestingly, on the rumor of this, oil really moved down trading into it. So some might speculate Russia was like forward selling or forward hedging because they knew they were going to blow it up. And then it blew up. And somehow the market, to all of the concerns that you just said, there's 7.7 million barrels of excess. Saudi's taking a big load and carrying a stick. UAE wants to grow. Russia wants to grow. Iraq's economy is really hurting. There's sanctions on Iran that's keeping 2 million barrels a day off, and there's a new administration, notwithstanding the assassination of a nuclear scientist there. But there's like so much that like if any one crack forms, and the market yet just traded oil up to 45, and even with them delaying from Saturday to Sunday to Monday to Tuesday to Thursday, oil's still 45. There's I read one of your company's pieces, and they talked about like there's 900 million barrels of oil plus products, like including products that's sort of out there. Maybe demand gets back to 96, 97, 98 million barrels a day, but like there's so much hope built into a $45 oil price. And then overlaid on that, there's sort of like this, well, commodities are going to be inflated because we're crushing the US dollar. Citigroup came out and said that they think they're going to depreciate the US dollar 20%, which would be good for oil. How do you overlay this commodity versus demand versus supply versus inflation versus pricing? Like, how the hell do you know what oil should even be priced at right now?
That is a great question. And the thing is that it seems that from a sentiment standpoint, then that whatever one of those factors kind of maybe dominates at the time can switch, and there's not necessarily a rationale behind it, right? It's because, there's an enormous amount of spare capacity that sits on the market, and that's independent of all the inventories that really need to be worked down. And that's independent of what the market is looking at to get back to what is normal demand, pre-COVID demand. It does seem to, there is an arbitrary quality to it for sure. And, like I said, kind of at the beginning, the fundamentals these past few weeks haven't changed, demonstrably. And even with a vaccine, we have a lot of work to do.
Yeah, I mean, so Exxon, as an example, Exxon going, and this is the amazing thing about sentiment, and I think on Twitter sometimes I see people say, oh, I really appreciate such and such from Chai Girl, and I learn a lot as an amateur investor. You don't want to be an amateur investor because if you try and pin fundamentals on something, you can get absolutely crushed. And so what was crazy to me was October 29th. Everyone was throwing in the towel on E&P. Like oil was 35. We were so long oil. E&P, Exxon was 32. There was nothing that could possibly be good. ESG was bad. Fracture ban, even if it's not legal, is bad. Everything was bad. Mm-hmm. And then in an instant, it just changed and Exxon rallied 33%. Mm-hmm. So you have written a number of pieces on Exxon, and this week they announced a $17 to $20 billion expected write-down on the XTO acquisition primarily.
Yeah. Mm-hmm.
Talk to me about Exxon as the bellwether and what you've seen and what it means and how you correlate also valuation of an Exxon versus the commodity price you're supposed to run in the deck. And is there supposed to be a connection, or is it just going to trade at a disconnect for a long time?
Yeah. So in Exxon's case, I mean, for the longest time, they were the industry bellwether. I mean, if you go back to, the 0809 recession, if you had a number of investors that wanted to stay in oil, they went to Exxon defensively, right? That was your safest place to be. You would still get upside if oil recovered, but you didn't have the risk of, say, going into an independent. But what you've really seen in Exxon's kind of underlying performance is that what made them the top tier, like the best in class kind of performer, has deteriorated materially. And XTO is a critically important part of that. I mean, it saddled them with a significant amount of US dry gas assets that have been out of the money essentially since they bought them. And that's not likely to ever change. And they finally had to come around, right, to this write down that they're going to take against this quarter's earnings. But there's something more fundamental to that as well. Exxon has always kind of been the conservative company, but a piece of them looked out, to the decades ahead and saw the outlook with demand for oil globally growing, and it was just going to keep growing, and there wasn't enough oil to meet that, right? Because it's pre-shale. Okay. So what they did is they thought, well, we're going to go and we're going to commit to the largest resources we can find, and we are going to out-engineer everyone else, right? We're going to go to the technically complex stuff. We're going to go to all the places that no one else can, and we're going to have proprietary technology, and we are going to be advantaged in perpetuity over others because of that expertise. The problem is that then you had shale, and you've had an oversupply in the market, and what's happened is that the prices that you could understandably expect if the world really was short supply haven't materialized. And so their underlying kind of base portfolio that they really started building, pre-shale, is just a higher cost asset base. And what has happened is that it's materially degraded their cash flows. One of the things I pointed out recently is, if you take 2005, when oil prices were about $64, and you look at 2019, when oil averaged about $54, their cash flows were 38% lower last year. That's pre-COVID. That has nothing to do with the pandemic. Their returns on capital employed have massively deteriorated. A lot of that has to do with their U.S. upstream exposure. But what happened, though, is that in that time, they see their kind of investment case as providing a growing dividend. So they have continued to grow the dividend, and they spent tens of billions of dollars buying back shares as well, dumping money into helping, their kind of total shareholder returns. But now they're saddled with a dividend that's twice as big from an outright, cost as it was in 2005, and they can't afford it. And so what really happened was they put out a couple years ago a growth story, which we weren't hearing anymore, right?
Right.
They were going to grow to 5 million BOE a day. And they couched it as the counter-cyclical growth, right? We're going to be there because we know shale is going to hit a wall at some point. We know that there's going to be demand, and we are going to be there. That's true, but they also frankly needed to make those investments, right? Everything they were going to invest in was a lower cost barrel. They needed it to essentially turn over their portfolio. And what has happened is they can't afford to do that now. They're having to pick between the dividend and that investment, and they're choosing to pick the dividend. And so what we're seeing is what also came out with the write-down is they've downgraded their capital spending program through the middle of the decade. And what they've just basically are said with that is we will pay you, we will pay you our dividend, but that portfolio turnover is just it's kind of indefinite at this point.
I feel like for those who are watching on YouTube, you'll see I just put my hand up because which is sort of like a combination of like I have a question, but it also relates to like a major flag. So a couple things from their release that I remember is this year, going into this year, if I recall, they were planning on spending somewhere around $30 billion of CapEx. They cut it to like 16 to 19. And then they've sort of talked about out to 2025, they're going to spend like 21 to 25. But in the first half of this year, when oil prices averaged kind of around 40, they produced $6.3 billion in operating cash flow. They spent $11.5 billion in capex, and they spent another $7.5 billion in dividends, which meant they had to raise, I think it was $17.5 billion or so of new debt. Now, unless you materially believe oil prices are going to be 55 or 60, which then brings all of OPEC's surplus capacity back, brings all the oil off ships, brings all the oil out of tanks and swimming pools and all the places that everyone's been jamming it, which seems unrealistic for a very long time. Why are they so focused on maintaining the dividend when it seems to be, I mean, it's a burden even if they didn't have it because they're not making positive cash flow? How do you reconcile that as an investor in Exxon? And then how, as you said, since nothing's fundamentally changed in 3 weeks except a vaccine, which we knew we were always going to get a vaccine, the data is showing that there's a 99.98% survival rate for people under 50, which means that most people under 50 aren't even going to get the vaccine. What is going on, and how is Exxon a defendable, investable company? Or is it just money flow and they're just like, well, I need oil exposure, it's big, I'll buy it, and then when it turns the other way, it's going to get crushed? What do you make of all of that?
Yeah, well, I mean, you've asked exactly the question that really kind of hasn't been answered, and they haven't answered. I mean, one of the things is that there's not just a disconnect in terms of the balance sheet, there's a disconnect in the messaging too. I mean, every time Exxon speaks, or even when they put out a letter to employees basically saying that they were going to be doing layoffs, they keep saying nothing has changed. Nothing has changed. Our outlook has not changed. And it's like, okay, well, at some point, something has clearly changed because you can't afford anything that you're doing, right? And so there remains a disconnect kind of at the top that there may need to be something kind of more materially changed kind of on the foundation, right? That it's a waiting game. And I agree with you, regardless of what they say about having a view on prices or not, they have to have a materially higher view on prices to just make the math work, right? And so, I mean, a lot of owners of Exxon, it's yes, there's retail investors, there's pension funds, all that, but I mean, think about them just being pushed off the Dow Jones, right? I mean, their position as the go-to stock is at risk. I mean, it's been materially degraded, but it's at risk. In their view, they see maintaining the dividend as the way to keep what they have and maybe get money back. But it's just not proving to be the case. I mean, it's a bit anecdotal, but it's just in terms of the interest. I counted like 8 analysts listened to Exxon's last earnings call. Like, there's just no interest in them because they just keep repeating the same thing, without kind of understanding maybe something's changing.
Well, it's also interesting to me because, I mean, and I'm going to go 2 ways, and then we're going to step back macro and go natural gas, and then we'll come back to Exxon. But, we talked about in all through 2019, and today I saw Oxy release their sustainability report, and I think Hess had everyone has a sustainability report. And I've been making the point for the 2 years since I started the Hot Take of the Day that we don't have an ESG problem. We have a G problem. And the G problem is we have people who are overpaid and crony boards who are not holding management teams accountable, are not turning over fast enough, and are not reacting to changes very quickly. And the evidence that I put forward to why we don't have an ESG problem, even though everyone wants to say it, is because Exxon went up 35% when fundamentals marginally changed because there was cash flow in, because there was cash flow out of growth. Mm-hmm. But it had nothing to do with any of the changes they made. I'm curious what you think of how management teams are interpreting this ESG pressure versus not. And then the other related question, is kind of like politicians with COVID. Is in March we didn't know a lot. And what we did know and has turned out to be more correct than not, like the Diamond Princess and percentages and etc. But maybe you didn't want to risk 350 million people in the United States based on something you didn't know. So politicians picked a path that they said we have to go lockdowns, and there's only lockdowns, and we can only do this until there's a vaccine. And now they can't not do that because nothing has actually fundamentally changed. So I asked that question in the context of Exxon. Is it that they've told people for 5 years, 8 years, 10 years that they're counter-cyclical and they always focus on the dividend, that like the management as people are so afraid to cut the dividend because they'll be fired, that even though it's the right thing to do, they just can't change course? And again, doesn't that say that we have a governance problem because no one is like taking new data and reacting? What do you react to all those comments?
Yeah, I mean, in Exxon's case, there's a truth to like the Exxon culture being very unique. I mean, usually more than other companies, people often work for Exxon for their career. They attract kind of a certain mindset, a certain approach to the business. And I think that one of the things we are seeing is a bit of kind of the almost like internal Exxon herd mentality a bit, that they kind of all buy into this view. And so there's not necessarily, voices that are maybe pushing back or saying, hey, look, can we come at this a bit of a different way? I think they just firmly still believe that in the long term they win. And I think that try to think how to put this. I think like if you look at Chevron, for example, okay, they are an oil company, right? They're not getting into renewables as power. They don't see that as being the right path for them. But there is like a willingness to kind of accept that the environment is changing and it requires some nimbleness, right? I mean, they are moving into gas in a way that they hadn't before, understanding that they're not calling oil demand peaking anytime soon, but it could be challenged and gas can maybe have a brighter future. They are looking at how to handle their operational emissions and realizing that they do need to take some responsibility so that they can tick the boxes for a greater set of investors. Exxon's just kind of like, it doesn't matter. That's nice. It's not our thing. So, I think there's just maybe a cultural disconnect there. But, in terms of the comment, actually, I did want to go back to you made at kind of the start.
The ESG kind of concept.
Yeah, and Exxon kind of popping, a bit. The market is signaling something because Chevron and Total are down about, say, 23% year to date. And Exxon, even with that pop, is down about 45%. Shell's down there too, and BP's down there too. And I think what's really interesting is that you therefore have a big oil major and a transitioning major who are performing much higher than a subset of big oil and transitioning. And it's like, well, what is that? It's like, well, okay, Chevron and Total haven't cut their dividend, but they can afford their dividends. And also, I would say there's a pragmatism to the way that they have discussed their plans, even though their plans are radically different, right? So you have a Chevron that's like very short cycle. Look, we believe in a future of oil, but we by no means believe that guarantees us a high price. And so that means that we have to operate in a way where we can be defensive when we need to. We're not banking on anything being given to us. And in Total's case, they aren't doing a BP where their oil and gas production is going to drop 40% in the next decade. They've even said, we see the bull case for oil prices later this decade. We think peak oil will come after that, but we see that. We're going to keep investing here, but we do have a plan to transition. And so I think what the market is signaling is that the fundamentals of balance sheets matter, that they are looking for pragmatism and something that they can benchmark, that they can actually, see results. They don't they don't want BP's McKinsey presentation.
Right. Yeah. So you talk about the future of oil and price. We also touched on gas, and we talked about Chevron. The Chevron. My favorite thing about the Chevron Noble transaction was its true level of accretion. I feel like relative to an underlying NAV, Chevron is clearly getting credit from the market. I mean, we are all a commodity price, and commodity price matters. So when one company's down 45% and the other's down 20%, it tells you the market is attributing a premium valuation to a Chevron versus an Exxon. They were able to go in and buy Noble at what looked like a relatively good relative value. They used all their equity, and they built a international gas portfolio through the Leviathan Israeli project, which is good. But at the same time, they sold out of the Appalachian region to EQT, if I recall correctly.
Yeah, exactly.
Which was an interesting, I mean, that felt like Chevron sort of announcing that they're going to focus more on international and less on domestic. Is that a fair interpretation of their strategy? And what did you make of that move in particular when you think about natural gas and pricing in the United States?
Yeah, on the gas side, ever since Chevron just kind of built out that position, it almost seemed like they didn't quite know what they wanted to do with it. Even for a while, they would get questions about, would you think about integrating this in a U.S. LNG export, asset kind of thing? And they said, no, we don't see that as competitive. I mean, frankly, until Noble, they were still largely talking about the fact that they preferred oil over gas. They liked being the most oily major. They saw more long-term value in it. So it's interesting that there has been a little bit of a shift there, but it just wasn't competitive. Right. And so even though, the medium-term outlook is improving for U.S. gas, I think going to their idea of being kind of defensive and having some flexibility, they don't want to over-invest. They would rather pick out the best assets that can work, even if it means kind of foregoing growth, right? And so in that case, they just made a decision. If we look at the slate of things we want to give money to, this isn't going to fit the bill. The Noble deal and getting that international gas exposure is really interesting in that region in particular, because the regional politics do have to cooperate with them. But there is real opportunity for domestic growth. These are growing populations. You have, regional markets, and then maybe you do have an LNG case kind of longer term too, but they're not necessarily banking on that. They kind of see them having a variety of different markets that they can access to, a number of different ways they can monetize that resource. So they're not having to bet on just a single investment case with it. And I think that seems to be what really has attracted them to that region. And I did have a chance to talk to Mike Wirth back in October for a bit. And, he kind of put it as they are more and more looking to be an all of the above producer. Again, they're not going to be a renewable power utility, but that they do see the need to, within oil and gas, diversify and then make that oil and gas, kind of as carbon efficient as possible.
So you talked about LNG, which again, similar to oil, there's a whole bunch of backdrop. The U.S. has grown far beyond what the demand for the domestic power is. There's a continued push to continue to use renewables to take up larger parts of the grid, which has obviously displaced coal primarily, but as we continue and under a Democratic leadership for 4 years, you could certainly see continued high grading of investments for solar and wind, which would then reduce the opportunities for gas to grow. And this week, I saw that LNG exports out of the U.S. were around 11 BCF a day. Which is an all-time high. And interesting in the backdrop of, again, this extreme bullishness that existed maybe 6 weeks ago for gas and drove gas to 330, at which point I had said then, as I say now with oil at 45, everyone better be hedging as far out as they possibly can, because this makes no sense. Then weather turns, we're exporting like crazy, but gas is still now back to that 275. What do you think about natural gas as Is it going to pivot from oil? Are we going to see some of these oily majors trying to take larger, more meaningful gas positions? We saw EOG is alluding to this Buddha play that they've had forever and everyone's known about forever, but nonetheless, it's new. Curious how you see natural gas all coming together in the next 4 years.
Yeah, it's an interesting question. Actually, one I've been kicking around for my colleagues. I can't say I have necessarily an answer to it, but it is this idea, like, does the gas upside serve as incremental, cash flows when, hey, look, we're producing oil, we actually get something for our gas this time. That's nice, kind of uplift, or is it actually something that becomes strategically a shift? I even with the oil's challenges, I would be really shocked to see, maybe a more pure play type, tide oil company decide to diversify into gas. I think that the overall, the fundamentals of gas do have a ceiling on them, and I know when you were talking to Dan Pickering, there was, discussion of, oh, well, could you see like an EQT, maybe pair up? I know it was hypothetical, but I would really be surprised if something like that happened. I would be less shocked if it just kind of became more within US companies, something that just, again, kind of offered maybe some uplift, through associated gas. Maybe something gets a little incremental capital here and there.
Well, it's funny that you say that because, obviously in my most recent working experience with One Energy, we were in the Delaware Basin, and very definitively, I said gas was a absolute waste product. Now, that being said, I have a vehement and obsessive view that water should never be trucked, and that gas should never be flared, and that infrastructure should be built to wells before you bring them on. Mm-hmm. So even though we had it as a waste product, we made sure it got to market. But it still doesn't drive that much. But I do think about parts of the Delaware, like in Culberson. I think about parts of the Eagleford, like in southern Dimmitt County, where obviously Noble has, through the Rosetta acquisition, a very gassy play they haven't done a lot with. Mm-hmm. It does seem like it brings optionality. And just from a pure power grid perspective, mm-hmm. it is good to have a lower CO2 footprint.
Sure.
So like you, I've been kicking around this whole like gas is good, and if an Exxon or a Chevron decided to go on like a public relations campaign to really push natural gas, you'd think they could do something more constructive. And yet for 10 years we've been in like a gas can't survive below 4, and yet here we are.
And yet here we are
below,
with
at
plenty of
250.
gas.
Yeah.
So yeah, no, I agree. I think, one thing that I think will be interesting to see, and this has to do kind of with the political change at the top, is, the flaring issue obviously is kind of a black eye in the Permian, and it's certainly the activity pullback that happened for completely other reasons, right? The oil price collapse. It will be, I would imagine that as activity does eventually get back to work, that the industry does kind of self-regulate itself to get that gas captured into market at a better rate than it has, so that it can try to make the case that gas does have a place in a lower carbon energy mix. Because yes, it can point to the fact that the coal to gas switching in the US has had a meaningful impact on US emissions declining over the past few years. But when you have something like that kind of is so glaring, can be pointed to, by critics, the message kind of doesn't work.
Yeah, and it was, for me, again, I understand, and this, so we're going to go back to oil and the macro, because, for a national oil company who has to worry about revenues that go to government, there's no competition. They're part of a cartel. It's a price-fixing scheme. And the U.S. kind of had this opportunity in March where, obviously, we have hundreds of companies, all of whom are working only for their self-interest and for management self-interest. So coordinating is both impossible and unrealistic, and none of them manage enough of the market to like,
And
you
illegal.
know, Coke, yeah, and illegal. But it's funny, like Coke and Pepsi like own 80 or 90% of the soft drink market. And so clearly they're taking symbols from each other, and no one says, oh, that's collusion, even though their drinks are all priced the same. But oil, like some little guy that produces 0.03% of the world's oil, like as though they can influence it, right?
Yeah.
But I thought it was interesting because we needed to shut in oil. There was unquestionably a demand problem. It led to negative $37 a barrel. Everyone knew it was coming. I was on CNBC March 20th and said oil's gonna hit zero, and yet no one did anything about it. And the industry actively opposed the RRC from imposing flaring regulations that to me just felt like short-sighted, bad business. Why do you think that was? And why, like, I think I saw Pioneer, who, as I recall, was one of the people against the regulations, but they came out today with like a sustainability report where they've added like flaring to their, like,
Right.
like it's sort of weird. It's like, I'm not going to eat spaghetti. And
Right.
then a week later, you're like, but okay, I'm going to eat it because it's my choice and I like spaghetti more. And it just seemed very incongruent.
Yeah. Yeah. Well, it's interesting. I almost would flip it on the other side, where maybe I would have expected the industry to maybe be more uniformly against, say, just regulation as like a practice, right? Saying, making the argument, if we are flaring, we have we're making an economic decision, and that is our right to. I was kind of been more intrigued over the past, year or so about actually more of a split. And there have been calls, obviously Parsley Energy is no longer going to be on its own, but actually advocating, saying, no, we actually should support this. We are basically held accountable by the worst actors in our industry. And if that takes some kind of, regulatory measure, why not do it here at the local level rather than, say, encourage something that could be far more draconian, or actually compromise, our license to operate kind of thing. So it hasn't been uniform. I can't, I do kind of, though, find some of the pushback to be self-destructive, a bit. It does, because I think that is the case. I think that, even in the US, I know this isn't Europe, but things have just become polarized. It's impossible to have like a conversation with any kind of nuance. And so you are going to be judged by kind of the worst actors. And so bringing people in line does benefit you and the industry's ability to continue to kind of operate and hopefully thrive.
Yeah, and and it seemed to me like, from a natural gas perspective. So, and think about the busy hustle bustle where, and midstream guys always got upset because the rig schedule would always change every day. And then they'd be going to a well that they somehow didn't know yesterday they should go to, but now they're going and they didn't have pipelines built, so they're going to just flare for 90 days. It's not a big deal. But then you look at a place like Colorado where you're building an oil field around a city, and so they really move to multi-well pads, which generally from a surface disturbance and from a cost perspective is really good. It requires VRUs for vapor recovery. It also requires pipelines, but like it was built into the whole development plan.
Yeah.
And with where the U.S. is at in a resource development in the Delaware, in the Midland, to not expect that guys just are building their business better. Like for a manufacturing process, it was still run very airy-fairy, kind of like do whatever. Again, I still don't see it. And with methane having 80 times the greenhouse gas impact that CO2 has, and only a 9-year half-life, impacting methane reduction today has a meaningful impact on whatever your view of climate change is immediately.
Yeah.
That should have been a message that everyone both picked up on and advocated for. And in Exxon and Chevron's case, I can't see how that would have been bad for them.
Yeah, no, I agree with you. I know Exxon has come out and said, well, look, for our own internal purposes, we actually have standards that, exceed what's expected. It's kind of like, well, but nothing is really expected. So, it's like, okay. Yeah, no, I agree. I think one of the things that has started to come out a bit in some of these sustainability reports you're hearing, or as independents start putting out some of their own emissions targets and things of that sort, is a number are signing on to the World Bank's end routine flaring by 2030. And in some cases, I believe it's Conoco is committing to do that sooner. It's coming around. It shouldn't have taken this long, but it seems to finally be like registering.
It's funny, and so I want you to push back on this statement. But when I hear companies talk about 2030 or 2050, I think like the carbon neutral 2050, we're all going to do the Paris. My natural reaction is they're not going to exist in 2030 or 50, because again, there's growth industries and there's capital access issues. And arguably with the state of our industry today, we're back to the 90s. Where we're in decline, as your point from Exxon that you made earlier on, they had a high cost asset base that was conventional. And the whole reason that we moved to shales, and the reason we were scared of oil scarcity and gas scarcity in the first place in 2001 and 2, was because the conventional business was not giving us growth for our growing energy needs. Shale filled the gap, but we have these high cost conventional assets. We have poorly capitalized shale assets, and we have too many companies. So I'm curious how you think that mergers, especially with the last 3 weeks where we've seen this really big run on equities, how do we see more mergers towards the ends of the year? And then as a related point to that, 3 weeks ago, everyone was talking about the bankruptcies that were coming because a lot of people were in a lot of trouble. Nothing's fundamentally changed, although the price deck in the near terms come up. In the end, it's kind of the same. But yet these companies that one would think would go bankrupt are trading up 60, 70% in the last 3 weeks. How do you reconcile all this, and how does M&A play a role in it?
Yeah. I mean, part of it, I think you have to, if someone's down 80% and then they go up 50%, they're still down a hell of a lot, So, I mean, the bar is low in some of those cases. So the equity, if you were to look even, you certainly over like a 2-year period is still, severely weakened. I definitely do see more mergers happening before year end. I'm not sure. I could see maybe what's going, well, again, barring OPEC plus suddenly causing the markets to be very disruptive, I maybe taking a pause. But, I think one of the things that is really been some of the most fascinating finds and like the S4s that have come out around the big mergers that we have had is how many of the conversations, even if they were casual, has been happening among E&P CEOs like beginning of last year, right? Again, pre-COVID, starting to think, hey, like, does it really make sense for all? Well, one, no, we don't think it makes sense for all of us to still exist. But even at kind of the top tier, are we big enough? Do we have the scale? Do we have the inventory, the diversity of assets to really kind of make this work? Not to say that there isn't a bull case to come, but can we really be kind of a thriving, efficient company that works for shareholders who are becoming increasingly apathetic to oil? Again, pre-COVID, pre-downturn. And so I do see that kind of move toward a smaller industry just being inevitable. And what has maybe happened the past few months is it's accelerated a bit with the big mergers we have. But I agree. I was surprised to see Concho be a seller. I thought they would be a consolidator. I know again Dan Pickering made that comment when he was talking to you last time. That surprised me, and it made me again kind of reassess what kind of scale are we really thinking about here in terms of what it takes for, a US E&P to last. I do think, though, that, and this will mean that maybe deals will take some time, is that quality will go for quality. It won't go for trying to go after kind of fire sale assets, thinking you're going to get something for a penny and turn it. I don't think anyone will want to touch anything that isn't kind of a top tier asset, certainly if it comes with lots of debt. So I think that it means that some of maybe the more tier 2 type companies are not necessarily going to get bailed out through consolidation. Maybe they try to merge with each other and see if they can come up with something that can be compelling. But be interesting to see. But I definitely think that's the direction that the industry keeps going.
Well, it is going to be really interesting because I totally agree with you that there are a lot of tier 2 assets that in a $40 world, in a $40 world, let's be honest, not very much works.
Yeah.
So let's say even in a $45 world where we sit today, there's not a lot of commercial drilling that can happen. And so, but there is a view, and I agree with it, that there is a bull case because underinvestment in oil is going to lead to declines, which is going to lead to higher prices. So surviving is a key. Yeah. But you have this additional element where a lot of companies used, and this is on Twitter all the time. I've put it in some posts in the past when I talked about the crisis of balance sheets. But something like $342 billion more of cash was spent drilling than was cash flowed over the last 10 years. And that debt is going to come due. But the holders of that debt have pretty unanimously been saying they don't want exposure to oil and gas loans anymore. But they're going to be forced to take the asset. Through most of these bankruptcies we've seen companies just wipe out the shareholders, and now creditors are owning a company they don't want. So how is that going to play out with these tier 2 guys? Because the tier 2 ones are the ones that'll go bankrupt, and they'll be owned by weak hands who want nothing to do with the equity. Do the bigger players end up coming in? Does private equity do a massive privatization roll-up? What do you think happens to the tier 2?
Well, it's tough because, even on the private equity side, we've seen so many kind of the generalists that were willing to, dump tons of money into shale and things like that, step back for good reason. They were among all that capital that's been destroyed the past decade. I don't know. I just, at some point, I don't know if there will always be buyers. I know at some point you can, you'll find a price and an asset will move. But just genuinely like the pool of people who actually have capital that they're willing to put to work, can put to work. If you're a private E&P, you have to make the case to your shareholders who are still around struggling, that you are really adding something of value. And we've seen quality companies go for almost no premium. So I don't know, again, if I have quite the answer, but I think it's just really tricky. You're just not going to have that liquidity in assets moving that we have seen because just the pool of buyers is smaller. And I know that this is a bit more international, so in terms of the commentary, but talking to some more on the lending side who said that it is becoming increasingly impossible for anyone who needs to actually wants to finance an upstream M&A deal. It's just impossible. No one wants to write those loans. The banks don't want the exposure either. So you basically have to have the cash on hand. If it can't be an equity takeover kind of thing.
Right. Well, and I think that will be the defining feature of 2021 is you do see companies like Concho, and I believed that Concho was going to get taken out. I thought it was going to get taken out by EOG because I think that, again, EOG is arguably the best, if not one of the best run independents. It has a phenomenal balance sheet. And when you look at their Karnes County asset, I would suggest that it's probably over-drilled and drilled too tight. I think when you look at their Powder River Basin asset, no one's really figured out how to make that commercial and of scale. I know guys are working on it. And when you look at their Bakken position, that was kind of played out, and all they had was Delaware. So it seemed reasonable that to use their expertise as a company taking over a Concho. But the cultural thing that we saw with COP was COP had to effectively accept that the 3 top senior leaders from Concho were going to move over, take meaningful roles at COP, and Conoco talked about laying off 500 people in Houston, which is basically making space for the Concho people.
Right.
So you can see how culturally you were never going to get an EOG Concho deal. So therefore, Conoco makes a tremendous amount of sense. If you think about on that sphere, so I'll stay in the big company world. I want to talk about Oxy. So obviously a huge amount of debt. And we won't go into whether it was a good choice or bad choice. I'm on record as to what my views were. And also 2019 April, oil was $73. 2008, it was 18 when they announced the deal. 2018, it was $73. But fundamentally, there's a cash flow issue. There's a debt issue. There's a sales issue. There's a midstream company that came with it that's also highly levered, and we haven't seen midstream valuations get crushed the same way I would expect. What do you think happens with one of those guys, again, assuming they don't get bailed out with this super cycle commodity price, US dollar gets crushed and oil is 60 kind of planet?
What happens to Oxy specifically, or companies of that tier?
Let's talk about Oxy in particular with all of the, because I think they're the poster child for great assets, lots of debt, lots of challenges, no asset market, different. How do they navigate without help? Because I mean, there's a lot of people who have said that Oxy's one of the first ones that go bankrupt. They exist, but curious your take.
Oh, see, I feel like they've kind of put themselves in this limbo. I mean, they're not touchable. Chevron and Exxon cannot buy them. That's not going to happen. And if you are like an EOG or something like that, why would you want to merge with that balance sheet, that portfolio? Even with the assets, I think they're going to have to go it alone.
I agree. I totally agree.
So I definitely, no one's going to help them. It's going to have to be on their own. Oh gosh. I don't think there's a silver bullet. I could see them not actually having to kind of throw in the towel and go bankrupt, but I could see them really having to. I know that it's been rumored that they're thinking about selling, like, say, their UAE assets or Oman or things like that. Those are solid assets. Those are not necessarily things you would want to get rid of otherwise. They may have to move those to bridge some gaps, but I don't.
It's a tough question, because I think about them on the large scale, being where they are in debt, and I think about Callan on the small scale. And in both those cases, because the debt is so toxic, just in terms of like the coverage ratios and the amount of cash you would need, it almost feels like with the recent rally in commodity prices and with the rally in equity, that all of these companies should be hedging everything for the next 2 years to take commodity risk off the table. And number two, converting as much debt as humanly possible into equity, because it's like a self-fulfilling story. If you convert the debt at a price that you like using inflated equity, then the debt risk goes away, which means your equity is worth more, which means you can convert more, which means you can be a consolidator. I would like to see Oxy I agree, no one can touch them right now. I'd like to see them as a consolidator. But again, it comes down to how do you convince the company you're going to acquire to take your equity. It would be like Elon Musk was in the news this week saying he would look at a rival car producer coming to talk to him about a takeover. And I'm like, that's because you trade at 1,300 times earnings, and your profitability is selling carbon credits to other companies who are making cars in California that are now making electric cars. If ever there was a time that Tesla should actually be going to buy companies with its inflated stock price, now is the time. And so I would make the same point on an Oxy, in that a fundamental value with their debt probably says they're maybe a little overvalued. So I would be trying to use my paper to buy as much humanly possible to strengthen the underlying value proposition that I had. It will be interesting to see if private equity takes some Oxy shares, or someone creditors through bankruptcies of whatever. Pick your guy. So last question for you, and I want to circle back to OPEC. If you put yourself in the shoes of OPEC, given what your point was, is there's budget cuts, oil is at a fairly good price. And what we have seen is every time OPEC takes the pain, U.S. producers ramp up. And U.S. production on the oil side has not declined, I think, as much as people, myself included, would have expected. And now we're seeing this ramp up at $45. What would you do if you were OPEC in the room for the betterment of your constituents?
Well, yeah. Well, it's a little bit hard because the spectrum of break evens across the countries, I know OPEC is about as wide as it gets. So in terms of their ability to weather a decision varies. Well, that's the whole reason why Russia and Saudi Arabia butted heads, right? Russia's tired of subsidizing U.S. shale. It's among the reasons why the fissures run deep. So to the point about fundamentals not being better, the point about vaccines and such still not being around, you can't pull the plug on it yet. The market would collapse to a point. No one was making money when things really hit the fan earlier this year. No one. Doesn't matter. Saudi Arabia, you got other costs. You're not making money. Your governments can't make money. No one was making money. You can't afford that risk at this moment. I think that, given that basically what they're talking about is a 3-month extension and they'll revisit things, I think you have to at least get to that point. And then if it really looks like the market is maybe getting ahead of itself, even further and shale is looking super healthy and they start talking about growth again or something like that, maybe you can revisit wanting to kind of kick them in the side a bit. But there's too much at stake for themselves to not come to an agreement. And, whether that means that some of the more disgruntled countries cheat a little bit, maybe that's how they play it. But they're not going to walk out without an agreement. There's too much at stake.
So if I were probably waving my magic wand, and if I was thinking from the perspective of OPEC, my current prediction is that they will increase production by 500,000 barrels a day. So go 25% of the way, which basically covers all the cheating that's occurred so that no one has to make compensatory cuts, and that they will expect that people will cheat between now and April. And they just won't talk about it. Right. And so that probably has $2 to $4 a barrel downward pressure on WTI, which pushes it to 40, which if I were OPEC, I would want oil as close to 40 as possible, because at 30, everyone gets screwed. Yes. At 45, the U.S. ramps up. At 40, it causes a whole bunch of problems. Mm-hmm. And then you can get the declines, which haven't materialized. And I will say on this point, I think that we haven't seen the declines because of the phenomenon of flush production. And it's something I wrote about when I was an engineer. I've talked about it a lot. It was a controversial thing. I used to say, if you shut in a well that was a year or a year and a half old, and you shut it in for 30 days, within 1.5 times the shut-in period, you would be able to produce through flush production all of the production lost, and you'd be back to the exact same point on the curve in 45 days. And I think what has surprised the market is there was enough shut-ins that were managed, because you don't want to shut in, 4 barrel a day wells, sure. But you're going to take relatively new wells that maybe had a pump go down or this or that, and shut the easiest ones down. And what we're seeing is this big flush, which is going to mask a whole bunch of declines from an exit rate. Plus, we're going to bring on a whole bunch of new wells to backfill that. But that fundamentally, once we get back on trend and the flush is done, we're actually going to underperform what people are thinking now. Like you'll see people on Twitter saying, U.S. has managed its decline better. I actually think we're just hiding the fact the decline next year is going to be worse. And so again, to an OPEC strategy, I would really want to squeeze to make sure the U.S. guys can't kick the can down the road. But that's just me. Well, good. Well, Casey, I really appreciate you joining and talking about the wide range of oil prices, OPEC, Exxon, commodities. Last question related to Thanksgiving. Did you have a good Thanksgiving?
Yes, I did. I did. Saw my husband's sisters for the first time since Christmas, so that was very nice. Yeah, I heard you were over on this side of the desert, I guess. Yeah.
I am still in Arizona.
Nice.
I am working on a New Year's Thanksgiving resolution to drink not, and to run every day, and to limit myself to 15 minutes or so a day on social media and Twitter. And I have found that for my personal health, and I encourage it to everyone else, if they're feeling like a little down by like COVID and like everything continues, taking that break from it has actually been very mentally, it made a very happy Thanksgiving. So that's what's been going on in Arizona. I appreciate you asking.
Yeah, absolutely.
Well, thank you again, Casey Merriman, for joining us. Until next time, be safe, be good, have a great day, and bye for now.